All right, welcome back to Talking Stocks. Good to be here for the second time this week. Todd, welcome back. Good to see you as always.
Hey, Joe, we've been having so many great shows with these wonderful guests on it. Just you and me. I feel like we need to needs to be somebody else here.
I know in due time, I'm sure we'll have another. I'm looking forward to it in the future. So we
Absolutely. That
have
was a great conversation we had earlier this week with Simon. So
it really
folks, if you
was.
didn't get a chance to tune into that, just go back and give it a good listen. It's basically everything you'd want to know about how to invest um, in innovation.
Yeah, I probably should have called it the innovation episode in hindsight, but oh well, hindsight's 2020. So we have all sorts of things to talk about today. Holy cow. I think I said this the last time we recorded, just the two of us, and I could say it again. We have 2 shows worth of content here easily. So we're going to kind of go rapid fire here. There are several different tweets that you posted, Todd, over the past week or so that have gained a bit of traction, and I think it would be worth covering them. So I want to start off with, let's talk about space. So you had mentioned this space ETF, or perhaps it's just a rumor, but why don't you fill us in on ARK's space ETF?
Yeah, so this is potentially pretty big news. I mean, I think that unless you haven't been paying attention, ARK is run by Kathy Wood, and they're having tremendous amount of success with their exchange traded funds that they've launched, including genomics and innovation ones, and just attracting tremendous amount of assets to those funds. As a matter of fact, I think I read this week that those funds are attracting, the only fund family attracting more in assets right now is Vanguard. That's crazy, right? But
Yeah.
yeah, crazy. But so, like anything else, I mean, if you're a growth investor, there's always something else to pursue and another bucket that you can invest in. So, apparently the team over at ARK has decided that the next big thing could very well be space. And final frontier, I don't know, but could be space, right? And so they're looking to launch a space-oriented ETF. And of course, that caused a number of different companies to just skyrocket over the course of the next 24 hours following that news cycle. And certainly something that, I think every investor is going to want to be paying attention because, yes, we're getting closer and closer and closer to, you heard about, I think it was Virgin Orbit. They were able to launch from a satellite from a plane in midair or something crazy like that.
Yeah, I did hear about that.
Yeah, I think Bezos's venture has had a successful takeoff and of their rocket and landing of their rocket. I think, obviously you've got SpaceX doing some amazing things. And those are all not publicly traded. And that's kind of a bummer because it's not like you're going to be able to get those in that ETF. But there will be other second tier type stocks that will probably be in it. I mean, you could see a stock that ARK has in its other portfolios, Trimble Navigation. That one, theoretically, you could put that into a space ETF. So maybe they'll add that one. I noticed that AeroVironment, which is pretty solid scoring in our work, AV is the symbol there. That was up like 20-something% the day after this news broke.
Wow.
And who knows, right? They don't own that as far as I know. They don't own that. They may, I'd have to go back and take a look. I don't think they do yet. But what's interesting about that, they're the ones who do the drones, Joe.
Yep.
So they have so many of those drones, AeroVironment. And then I believe that they're the company behind the Mars. The most recent launch to Mars by NASA, part of the payload is a helicopter. And I believe that they were the company behind the helicopter. So they're going to see whether or not they can fly a helicopter on Mars.
That is neat. I did not know that.
Yeah.
Very cool.
So that's kind of potentially exciting and interesting news flow. So I know I've started to write down a bunch of different ticker symbols, and I'm going to be watching them to see if I can get entries in them, and probably makes sense for our listeners to be paying attention as well.
Yeah, Virgin Galactic certainly comes to mind, right? SPCE.
Absolutely, and I'm long that in my personal account already.
Mm-hmm.
So yeah, I would that's definitely one. Good point.
Yeah, it's I wish we had gotten around to talking about space with Simon on Monday, because I think that it definitely fits into that question I kind of asked him with, what are you looking forward to in the next year or even the next 10 years? I mean, you could throw space in there right next to genomics or machine learning. I mean, I think that we probably can't even fathom right now what the kind of space economy is going to look like in 2030.
Right. I mean, you can start to draw maybe draw some conclusions. Robotics
Right.
companies probably would be something that you want to be looking at. Obviously anything having to do with propulsion, anything having to do with automation
Yep.
would probably be something to look at. Interestingly enough, think about mining companies, but think about mining equipment companies. You
Yeah.
know, from a robot angle. I mean, if you're able to control remotely um, your John Deere tractor in your field, picture landing on an asteroid and remotely controlling your mining equipment or whatever. So I think that there's so many different. This is going to be a really exciting area to watch over the course of the next 10 years.
Yeah, it's fascinating. It's gonna be really cool to watch. So going forth, using your Twitter profile as basically my notebook here. I guess so. There were a few that we wanted to cover. I'm gonna go ahead and bring up what you kind of called the buy and hold camp. Um, so you had tweeted out, I'll just read this for our viewers and listeners. If you bought Amazon in late 1999, that is, you could have been sitting on a loss for over a decade. Cisco, you could have still have a loss 20 years later. GLW, sorry, I don't
Corning.
know what that company is, but
Corning.
if you bought that, you could still have a loss 20 years later. And Qualcomm was a loser until 2019. And then you go um, on and on that. But I think the important takeaway is, just a lesson there about growth, right?
Yeah, and this is a reason that on the show, the course of the last, I don't know, month, 6 weeks, whatever, I've been spending more and more time talking about sell disciplines and trying to, whenever we have a guest on, we talk about, what is it that, how do you think about your rules for walking away from an investment? Because it's when you get to periods where you've got stocks that are, running significantly higher than the 200-day moving average, when they're really elevated, they move parabolic moves or whatever, however you want to define it, vertical,
Like
right?
70% of stocks are right now.
Right, exactly. Right, 78% now, more than 5% above the 200-day moving average, which
Oh
is
boy.
just a crazy number. And some stocks are 150%. That's crazy when you think about that. Stock could fall 50% and still only be touching
Oh yeah.
its 200-day. And when you get into those kind of situations, I think that you need to recognize how, especially if you're leveraged. I mean, that's why I hate leverage. I don't use margin. If I look at my big losses where I've had nice gains and I've lost a lot of money afterwards, it's because we've moved into an environment which has been a bear market or unfriendly or whatever, and I've had leverage. And leverage cuts both ways. You get the forced selling and you end up having to liquidate great stocks. And the point that I was trying to make with that, it wasn't to ignore the fact that if you had sat on Amazon from 1999 till now, you're doing fine. It was to recognize that there was a 10-year period of time where you could have bought at the peak in 99 and still been underwater on it. And, I think the amount of opportunity costs associated with that alone should give some investors pause. That buy and hold, as I've joked in the past, buy and hold shouldn't be buy and forget.
Yeah.
There's a time to own companies. And you need to have risk controls. So, I think that the final thing that I would just say on that, Joe, is that, it's not like these companies weren't still growing.
Right.
So I see a lot of people on Twitter and elsewhere saying, oh, here's the size of their addressable market, huge addressable market. I predict that this company is going to grow their revenue 20, 30, 40% a year for the foreseeable future. Well, these companies were growing their revenue by double-digit percentages, and they were still losers just because they had pulled forward so much of that, priced in so much of that growth already at the front end, right? So just because they're could still be growing their business doesn't mean that it's necessarily going to be a big winner every year. So you have to plan ahead and you have to be aware of that.
Yeah, the other thing I would point out there just before we move on is the how you classify forever stocks doesn't mean that you're actually going to hold them forever. So it's important to keep that in mind, especially, it's one thing when you're when you're in your 20s like me to say that. And I have stocks that I own that I have no intention of selling, but 20 years down the road, when I'm in my 40s, things change. And so while I don't have any I don't foresee myself selling something in the near future, in the next 10 years, 20 years from now, God only knows. So yeah, a
Right.
forever stock is
Forever,
not
I think,
actually forever.
yeah, forever is kind of like a mindset. It's just
Yeah.
and I like the word you used, intention.
Mm-hmm.
It's when you're going in and you're buying, you're saying my intention is to hold this and let it play out. My intention isn't to spin it. My intention isn't to hold it for 6 months or for a particular catalyst. I have a big theme and my intention is to hold it. And however long that period of time is however long it ends up being,
Exactly.
but the market will tell you when it's time to walk away from that idea. And I think that that's why it's so important to have rules that govern not just when you buy a stock, but also rules to govern when you're willing to say, yeah, I need to walk away from this stock.
Yeah, totally. So continuing on our rapid fire using your Twitter feed as a notebook, I want to bring up another one that you tweeted out a couple days ago. From a book you've been reading, which is not a new book. Now, if anybody follows Todd on Twitter, if you don't, you absolutely should. But if you've been following him for a while, he's a big reader, right, Todd? So you frequently tweet out books that you're reading that are quite old, and there's probably a lot in there that's outdated, but there are still a lot of valid points. And sure enough, this book from Stan Weinstein, which is, I believe you say, 35 years old, has some very current wisdom in it still, doesn't it?
Yeah, and here's the prop. So viewers, you
There it
can see
is.
what the book is. You can order on Amazon for yourself. I like to go through, Joe, and reread all these. Most of these books I've already read once, but I like to reread them every so many years just to see, okay, remind myself. And I think that when you're an investor, you can never stop learning. You have to always be kind of taking in information, and because things are resonating with me now in this book that weren't, maybe didn't resonate with me the last time or whatever. And so I think it's important to go back and reread those kind of books. And one of the things that I posted, as you're going to talk about, was something that I saw in this book. And I was like, well, this is the perfect timing for me to share that piece of information.
Yeah. So I'll just share my screen, actually. I think this will be easier for those of you who are watching. If not, we'll try to give you the best kind of guidance through this. So what I wanted to show is this little excerpt from the book here, and I'll read this. So this is a series of bullet points for those who are listening. Heading is Summary of Short Selling Don'ts. Don't sell short because the PE is too high. Don't sell short because the stock has run up too much. Don't sell short a sucker stock that everyone else agrees must crash. Don't sell short a stock that trades thinly, and don't sell short a stage 2 stock. So Todd, while I have this up still, do you want to kind of run us through, like, some of these are fairly obvious, PE is too high, that makes sense. But like, for those who don't know what he means when he says like trades thinly or a stage 2 stock, you want to just run through these one by one and kind of like explain what he means?
Yeah, absolutely. And I think the reason this is just it's so true. I mean, this was 35 years ago, and think about how much money, Joe, especially just look at Tesla.
Yeah.
I think about all the people who continue to bet against Tesla. if they just followed this advice, how much money would they have protected? You don't necessarily have to short something just because you don't believe that it's a good buy right now, right? So anyways, but Weinstein's saying here, the first point, don't sell short because its PE is too high. Well, that's because William O'Neill did all the research going back, and he found that actual high PE stocks end up usually ending up with higher PE stocks. So meaning that high PE stocks are often the biggest winners going forward, which kind of works counterintuitively with what we're told when we're new in the business, where it's like, oh, buy low, sell high, right? Well, no. What we tend to end up realizing is that you make far more money when you buy high and sell much, much, much higher. So try not to make a judgment on whether or not a P ratio is too high, because that's what it is. It's your own personal judgment. It's your opinion that a P is too high. So don't sell short because of that as the reason. The second one, don't sell short because the stock has run up too much. And again, that's your opinion. Your opinion is that it's run up too much. The market doesn't care what your opinion is, right? You need to be thinking more like, okay, has the stock run up too much and does everybody already own it? If in that kind of a situation, maybe you would say, well, there's no buyers left, but it's just not worth it. It's not worth trying to make that argument. So don't sell short because the stock has run up too much. Don't sell short a sucker stock everyone else agrees must crash. Again, you could use Tesla for each one of these, all 5 of these points, right? Everybody was betting against it, saying that they weren't going to survive, the balance sheet was broken, blah, blah, blah. When everybody believes something is likely to happen, the market will invariably surprise and go the other way and disappoint everybody. Don't sell short a stock that trades thinly, right? Okay, so you're going to short a stock that only has maybe 30, 40, 50 million shares outstanding. Maybe that only trades 10 or 20,000 shares a day. Well, guess what? Those stocks are so easily moved. It doesn't take a whole heck of a lot of demand to make those stocks go to the moon. And so all you need is to have somebody else decide to cover, or you need to have some big institution come in and decide that they want to have exposure to it, and you're going to get absolutely run over and buried. So stay with very big liquid, where there's lots of supply, and you're not likely to get run over by one big buyer who shows up. And then don't sell short a stage 2 stock. And really what Weinstein's whole philosophy is that you buy stage 2 is basically, there's 4 stages. Stage 1 is where it's going flat. Stage 2 is when it first breaks out and then goes on your incline. And then stage 3, it flattens out again. And stage 4, it retreats all the way down until it forms a stage 1 again. So stage 2 would be, don't sell it if it's in stage 2 and it's accelerating. And again, the idea is, are you going to be the hero? You're trying to pick this winner, you're going to be right and everybody else is going to be wrong, so you're going to short this thing as it climbs. So I think that one of the things that we hear a lot, like we produce a best and a worst list every week, right, Joe? So in our research, we have these reports that come out: large cap, mid cap, and small cap. It shows you the best industries, the worst industries, the best sectors, the worst sectors, and it shows you the best stocks and the worst stocks, right? Well, the worst stocks, people will look at it and say, well, why are these stocks not these high flyers that are completely overvalued? It's for exactly the point that Weinstein was making, right? We don't believe in that. What I believe and what our research shows is that it's much better to avoid or short broken companies, bad businesses. If it's a bad business and price volume stinks and the stock is in distribution, those are the ones to short. Short bad businesses. Don't short great growing businesses, right?
Yeah.
So our worst list is going to be compiled of those kind of stocks, not these high flyers.
Yep.
And conversely, the best list is probably going to be more along that O'Neillian or Weinstein or something like that kind of theory of you're finding good stocks that are rising and they're growing, good businesses. They're rising and being rewarded by the marketplace.
All right. I'm so glad you gave me a great segue into our next topic. Speaking of great growing businesses, let's talk about Netflix. So Netflix, if you haven't heard, had a pretty big announcement this week. And to correspond with that, the price, the share price just absolutely soared. So, Todd, to get us started, feel free to pull up a chart if you want, but just kind of walk our listeners and viewers through what caused the price spike.
Okay, so let's go through the numbers, right? The company added a net new 8.5 million subscribers. That was up 22%. Expectations were only for 6 million subscribers. So it added 2.5 million more subscribers than expected. That brought it up to 204 million members. Revenue was in line with expectations, up 21% year over year. Profits were a little bit below. Guidance for membership growth was pretty strong. And as a result, stock went to the moon. And let me share my screen so I can pull that up. And we can see, let's see here. You'll notice the chart I have up there, Joe, is UFO, which is the
We were talking about that
CTO.
awesome symbol.
Yeah, one of the best symbols, right?
For sure.
All right, so now we go over to Netflix here, and you can kind of see here, we're going into the earnings report and just absolutely blew it out and broke out of all of this back to July of 2020, and the volume, just crazy volume.
Oh yeah,
on that news, crazy volume. But I know my opinion on Netflix, Joe.
We have
is
differing
not your
opinions
opinion
on
on
Netflix.
Netflix.
No, so this is what I kind of wanted to get into. So I have to admit, when I saw this price spike, I laughed out loud, because the day before this, so this was yesterday. So we're recording this on Thursday. This happened on Wednesday. On Tuesday, I canceled my Netflix subscription. And so the only thing I could really conclude is that I was the only thing holding them back. But I think that my reason for canceling my subscription is also my reason for concern about Netflix in the next 10 years or so. So we know that the streaming world is getting very crowded very quickly. And my opinion is Netflix is already so big and so well established that in order to keep growing, they're going to have to change or add something that really changes the business in a fundamental way. So you look at Hulu now. I saw an ad the other day. They're doing a package with Disney Plus and ESPN Plus. So Hulu has live sports anyway. I know that from all those commercials. Thanks, Hulu. And obviously ESPN is going to have some live sports as well. And then you get all the content from Disney. So you package that all together and you get that all under one umbrella. Frankly, Netflix can't compete with that. Netflix doesn't have any live offerings that I know of. And so I'm starting to think that this is Netflix's peak. And I know that you have been a Netflix bull for quite a while now. And so I'm curious to see how your take in the next decade, because I think the next decade is going to be really pivotal for streaming. So I'm curious to see how you think Netflix can kind of survive this onslaught of competitors from all different angles.
Yeah, I mean, you're really talking about what's their optionality. I feel like that's kind of the question. I mean,
Yep.
Back in the day, it was competing with Blockbuster, and it was just, okay, let's have a subscription where we mail you the DVDs, and that put Blockbuster out of business, right? Because you didn't have to go to the store anymore to get your DVDs. You could just get them in the mail. And then they said, hey, let's actually start to deliver this via streaming, so we don't even have to deliver these things through the mail. And people were like, oh, what are you doing? You're blowing up your entire business model. And of course, it turned out to be an absolutely brilliant and prescient decision by very qualified leadership in Hoffman. They're just crazy smart business decision. And now obviously 200 million subscribers. That's a lot of people, to your point. So the question is, at that point, okay, you've got 200 million people already who are using Netflix. Where do you go from here? How do you continue to grow and, really compete. And I think that that's one of the things that I think you're making a valid point. I think that there is a valid point to that. Although it doesn't take, it doesn't take, you can add a couple million a quarter and keep adding a couple million a quarter, and that's still pretty needle moving.
Yeah.
I think that the big question, Joe, and this is also kind of to your point, the big question is going to be, is the content on Netflix going to be compelling enough to keep the rest of the subscribers as
Like
subscribers?
me.
Like you.
Yeah.
Right. Now you made the decision, hey, no. No, I'm out. So,
Yeah.
but now, now you're not going to be able to see George Clooney's new movie. You're not going to be able to see.
Yeah, I'll
You
just have to tap into the Netflix account of honestly everybody else I know has Netflix. So I
right.
really don't feel like I'm missing out on anything.
If they ever figure out exactly how to tap down on the sharing, and they probably will, they're probably already doing it right now. That's one of the reasons that people have to get it. I don't know. I always look at Netflix as like Hulu is kind of positioning itself with the live content, some of these other Roku and some of these other ones. They're positioning themselves as a replacement to traditional cable, meaning that you're still going to be able to get your live coverage and live. Netflix has never played that game. It's always been kind of like, no, we're separate from that. We're an add-on that you would want because we have entertainment value. And I think what's really interesting to me to see how this plays out from here is going to be how, all right, if AMC Entertainment and all of these, cinemas that have closed up, how many people are going to continue to go back to them? Or is it just going to be now, I mean, we've seen some of the production moving to, okay, we're going to release it in the theaters and we'll release it online at the same time. I don't know. I don't know. For me, it's still pretty short money to be able to get the entertainment I want out of it. But I have found myself at times saying, do I really need to have Netflix? And I'm sure a lot of people are in the camp that you are, Joe. I'm long the stock. I've been long the stock for a long time. I'm up over 300% on the stock. I have no plans to sell the stock. I think that the questions you're asking are right. And, those are the things that you're going to have to keep an eye on. I'm going to have to keep an eye on. But yeah, so right now it's rated a hold in our ranking. Price and volume just soared last week, so I'm assuming that the score is going to start to climb a little bit. So we'll have to see. There's a big gap to fill now from that move, that single day move. Usually stocks do fill the gap at some point. So maybe, if you haven't bought Netflix or you're interested in Netflix, Joe isn't, but if you are, then maybe you take a little now and then you wait and see if it comes down, you take a little bit more. And then if it comes down and fills the gap, take the final third tranche.
Yeah. I think that, going back to what I've kind of been harping on all week now, the whole kind of next 10 years thing, like I can't think of another industry that will likely change as much as streaming will in the next 10 years, except for maybe something in healthcare or diagnostics. But I really can't even fathom like what the streaming world will look like in 10 years. Is it going to be everybody has 3 different streaming subscriptions that cost just as much as cable did? Or is it just going to get to the point where everybody starts pirating everything because we're just sick of paying for stuff? Who knows, right? We certainly don't project out that far. But
yeah, I mean,
I'll look
what's the
forward to watching
disruption
it.
going to be, right, Joe? Is it going to be that we're going to have holograms? Is that I mean, where do you
Yeah.
go from here? Where do you go from here?
Yeah, VR is certainly a possibility. Yeah, there's just endless possibilities, generally speaking. So after that somewhat long-winded conversation, do you want to get us a little smattering going before we call it quits for the day?
Yeah, I mean, I think one of the things, I mentioned earlier that the research every week, we're looking for the strongest sectors, we're looking at the sector ranking, we're looking at the industries, we're looking at the individual stocks. So every week I like to go through before we do the podcast and say, okay, what jumps out at me as far as changes occurring in those rankings? And the one thing that did jump out to me, and caution, 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 I'm actually going to energy, which has been climbing our rankings since December. I think we first gave our smattering of energy stocks to look at in the middle of December, something along those lines. They've done very, very well. The energy sector is now the top large cap sector. And it's a little scary because energy does this sometimes. It
Yeah.
runs up, especially in January for some reason. It runs up and then it peaks and it rolls back down. So I see this, I see it. I went back and recalculated it. I actually did the numbers twice because I was like, wait, is this for real? And yeah, it's the strongest one. So I think that the investors need to be paying attention to energy right here, if you're an aggressive investor. And I think what you would do is, again, this would be rentals, because cyclicals I always call rentals. I'm very rare that I would label something unless it's a energy stock like say solar, but that would fall in technology for us.
Yep.
Wouldn't fall into energy for us. So anyways, these for me would be cyclicals. They would be rentals, and I'd be following these up with stop losses and protecting them, either underneath the moving averages or set yourself some sort of a limit or under support or whatever. But protect yourself from these things rolling back over. But we'll punch up a few of those charts, Joe. I'll punch up some other charts. We'll do a fairly good smattering. So what I'll do is let me share my screen again, and we'll pull up some of these, and that's Netflix, which we were just talking about. And Joe, you can see the charts okay?
Yes, I can.
All right, I'm just going to move this out of the way down here so we can do that. All right, so yeah, we talked about energy, and just to give listeners and viewers on YouTube just a little bit more color, we'll pull up the Energy Select Spider ETF just to see where has moved since November, coming from 30 all the way back above the 200-day moving average, down at $42. We did see these get beat up a little bit today, and that's not a bad thing. I mean, that could be giving us an entry into some of these stocks. And then the other one I like to follow in the exchange traded world would be the VanEck Vector Oil Services, so energy services and equipment stocks. And you can see that went from $87, $88 in the fall to peaked out around 185, and now has pulled back to 168, sitting back on its 21-day moving average. Our first ideas back in December included Core Labs. That's obviously been a big winner. I think we talked about Halliburton. That has been a decent winner. We talked about Diamondback Energy, which is FANG, as one as well. That still looks pretty good. I would also add CNX to the mix. We've got this nice pullback here, right towards the 21-day moving average off of its prior high. It's still profitable. It works. It's a shale producer. So I would actually take some CNX right here, see if it holds, and then run a stop loss below. Oh, I don't know, somewhere down here, maybe below 10, and get stopped out of it if it turns out I'm wrong. I'll give it a little bit of room to fluctuate, but that would be one that I would add to the list. And I'll also add PXD, Pioneer Natural Resources, to the list as well. This one's a little bit more extended, but I still think you can buy a little bit here, see if it holds the 21-day. If it doesn't hold the 21-day, you can stop out of it either there or below the 50-day, depending on how much room you want to give. But again, you're talking about a profitable shale producer with earnings looking to bounce back in 21, as long as oil stays high. So those would be two more that we can add to the energy side of the world. And then outside of energy, there were a number of stocks I wanted to talk about as well that had piqued my interest. One of them being, I don't know if you've seen them you're up at another ski house this weekend. I don't
Yes.
know if you've seen any of Polaris's snowmobiles kicking around, but
I am in basically the snowmobiling capital of Maine right now. So these are about as common as a as a Toyota Corolla up here.
I just see if we have to figure out whether or not they're new or not. We can kind of do our own little research experiment here on Polaris. But I mean, this stock has just got everything I like to look for. I mean, as far as we got the double-digit growth. It's working in an area that has some seasonal strength. We just busted out to new highs off of this pivot level. I think that this is a stock that could go meaningfully higher from here. So we'll see. So that's Polaris. I would have that up on my list, on my watch list, see if you can get an entrance on it. Teladoc is another one that is flirting with breaking out past, you can see it peaked back here in July when it bought Livongo. It's been marking time ever since then. And I think that 2021, now we're going to get to see whether or not they're able to leverage that Livongo acquisition to really, really get the cross-selling going. And I think the answer is going to be yes. I think, chronic disease intervention is kind of where it's at. And even if you get a slowdown in telehealth once vaccines are out there and maybe we're going back to the doctor normally again, those other parts of the business, I think, could really end up being big for Teladoc. So I would have that on my list. I would also have Ollie's Bargain Outlet. This is one that I think is pretty viable right here, right above the 200-day. Again, I use charts for entries and exits. So I'm a story first investor. I like to have my thesis, my cast. I like to look at the numbers as far as revenue and earnings and operating margin. But I will use charts to help me time my entries and my exits. I like this entry point right here because, Joe, you can define that exit. It's not far above the 200-day moving average. And certainly, if people do get out and they start shopping again and going to stores, Ollie's Bargain Outlet is one that could benefit. I'd also wanted to highlight apps, Digital Turbine. Digital Turbine's kind of operating in kind of a sweet spot here because of, we're seeing the increase in connected TVs and the apps that you can install on your connected TVs, but you're also got this 5G upgrade cycle, and Digital Turbine makes its money from basically the placement of apps on newly activated phones, et cetera. So, you can see you got 116% year-over-year revenue growth last quarter. You got earnings in 2021 going from 20 cents to 63 cents per share, to 2022 going up to 85 cents per share, 35% year-over-year growth, 21 to 22. And you've got to break out to new highs to pull back towards that 21. I'd buy anything on that pullback to 21 day and then maybe stop out below it. But this is a stock I actually own and I plan on keeping for a while. So I would probably give this one a little bit of running room as far as, let it bounce around a little bit. I think that that's fine. Let's see, what else do I have on my list here to look at? You can also take a look at FIVN, which is kind of like think about companies today and their need to be able to communicate with customers however the customer wants to communicate with them. And maybe that's via phone, maybe that's through a message, maybe that's, there's lots of different ways that we can communicate as a company with our customers. Five9 enables that with a cloud-based approach. So that would be the final one that I would share today as a stock that maybe you can take it a little above and put that on your watch list as well.
All right. Yeah, great smattering. I will put all of those in either the show notes or tweet them out, one or the other, maybe both. But yeah, that seems like a really good place to wrap up. It was a great conversation. And yeah, we'll be back next week one way or another. I don't know if we have any more guests queued up at the moment, but hopefully we'll get some more of that going in the near future. It's been fun doing 2 podcasts a week. I've been enjoying it. I know you have been too, Todd. So yeah, any parting words?
No, just remember, don't short.
Don't short.
Don't short stocks that are breaking out great companies. Short broken crap companies. Don't short fast growing companies.
Yeah, don't short Tesla is really the long and short of that one. And with that, we will say farewell. We'll see you next week, everybody. Take care.